heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Apple, it scraps its EV ambitions after a decade-long effort as the company focuses instead on AI. We'll have full coverage ahead.
Plus, Google CEO Sundar Pichai blasting the failures of the Gemini image generation feature as the company looks to remedy the situation. We have all of the details.
And we sit down with the CEO of data automation firm Klaviyo as the company reports earnings for the second time since going public. And as they announce, guess what? New AI products. All that and so much more coming up. But let's check in on these markets because there was a torrent of economic data, not much to catch the attention today. Mixed data means that we're currently off about 0.4% on the NASDAQ as we really care about the PCE number, the favored inflation data by the Federal Reserve that comes out tomorrow. All eyes on that. We see a little bit of a sell-off ahead of that number. Golden Dragon Index over in China, of course, this is the US traded version of some of these Chinese big names, down 1.5%. So really some weakness coming over from what was a pretty ugly day in China trading. I'm looking at what's happening in the 10-year yield. Nothing burger, nothing really moving. We're off just about 1 basis point. Where there is action, and on the macro perspective, if we're looking at one particular asset class of choice, Bitcoin. Look at this, 7.7% higher. We are encroaching on that all-important $69,000 record level, Ed. We know the 61,000 has already been eclipsed. Why? Good old supply-demand dynamics. There's more demand from the ETFs. The supply side we know is going to be halved in terms of amount of Bitcoins going to be mined come end of April. And of course, well, not many holders are selling at the moment. But Ed, what are you watching?
One story, Apple. Apple is shutting down its car project after a decade of work. Full kudos to Bloomberg's Mark Gurman. He's going to join us in just a few moments. He broke that story, but this is a 2-day chart. That is the moment that Mark broke the story. The stock would have been a little bit lower Tuesday, and look at the gain on it. Okay, we're flat now, but the reaction globally to this has been pretty profound, actually. We know that some of the 2,000 people working on the Apple car project will lose their job. Some of them will be shifted into Apple's work on generative AI, according to Mark's reporting. But for me, this story was about 10 years where Apple did not know what that end car product, EV product, robo-taxi product would eventually look like. And you've seen it all over social media overnight and this morning, Caroline. It's the one thing everyone's talking about.
A big backtrack. And, well, they talked about it over that decade-long process. Here's actually Tim Cook and what he had to say about the plans all the way back in 2017. Take a listen.
We sort of see it as the mother of all AI projects. It's probably one of the most difficult AI projects actually to work on. And so autonomy is something that's incredibly exciting for us. And but we'll see where it takes us.
And Mark Gurman joins us now. Isn't that interesting, the fact that Tim Cook talked as the mother of all AI projects, and that's where the talent now goes, but to generative AI?
It's certainly an AI project, right? At the very core of an autonomous self-driving system is artificial intelligence, using cloud, using onboard software, using onboard hardware to understand where the vehicle is, do live processing, and make those decisions using an AI engine on behalf of the user, whether to stop, whether to make that turn, whether to change lanes, to understand the environment, to drive in the snow or drive into the rain, right? Those are all decisions that are made by an AI processor. And so clearly Apple does have some AI talent there that they're able to relocate to their other AI initiatives that have nothing to do with the car.
Mark, let's go deep into the details that you reported. So there was a meeting held by 2 high-level Apple executives where they informed the 2,000 or so staff working on the Apple car project that it was being shut down. What else do we know?
Yeah, there was a meeting Tuesday morning at 10 a.m. where Jeff Williams, Apple's COO, and Kevin Lynch, Apple's VP of Technology, who's been in charge of the car project known as Titan inside the company since 2021, they informed the team, like you said, that the project would be winding down immediately. Really, three main groups there. You have the hardware engineers. This is simplification, but you have the hardware side, you have the software side, and you have the AI side. So the AI side of the project will be shifting towards Apple's AI and ML division under John, Gene, and Andrea. The software side, most of those folks will be moved to Craig Federighi's operating systems organization. And then the hardware team, a lot of those people, unfortunately, are being laid off. It's one of the biggest layoffs, I'd say, in Apple's modern day history, certainly since Tim Cook became CEO in 2011. And then some of the hardware engineers will have the opportunity to apply to other jobs within the company. Obviously, Apple's a hardware company, and perhaps some of those people will find roles on other teams, whether that's for the iPhone, the Vision Pro, the Apple Watch, you name it. But this is a bombshell development for Apple. This is something that Apple just doesn't do, throwing in the towel on a major project in such a public fashion. The Apple Car started in 2014, 10 years ago. And Apple's such a secretive company, but everyone knows they've been working on this. So this has been a really public failure for them.
Bloomberg's Mark Gurman, terrific reporting, impactful reporting. Thank you for joining us on the show. What does it mean for Apple? But what does it mean for the EV industry at large? Let's bring in Citi's global head of autos, Itai Michaeli, to get into what Apple winding down its electric car effort means for names like Tesla. You look at Tesla shares up 2% in the session. Itai, your thesis seems to be that if this is good for anyone, Apple cancelling its car project, it's good for Tesla. Why?
Absolutely, yeah. So, we always thought that Apple would have been most likely to compete directly against Tesla and to a lesser extent companies like GM and Ford. A lot is changing with electric and software and autonomous, of course. But one thing that we're learning, not just from this news, but even other developments recently, is that the barriers to enter and succeed in scale in the EV and particularly also in the AV, the autonomous side, are still pretty high. And so I think this is another data point kind of supporting that those barriers still do exist. And we think, it does bode well competitively, probably most so in our coverage for Tesla and to a lesser extent GM and Ford.
Itai, you lead autos coverage at Citi as opposed to Apple. But what I always think about when I've covered this story of Mark over the last 6 years or so is Apple is used to margins for consumer electronics. And even if you get to Tesla level margins, it's not even close. Did you have any sense of what you think Apple was trying to get out of a car project?
Sure. Yeah, I would say broadly for the industry, we see the biggest opportunity for higher margins is in software services and particularly around autonomy. And if you look at the average automaker today in the U.S., we've estimated that from the lifetime revenue of a car today, those automakers only generate maybe 40% of the lifetime revenue of the car. There's a whole other 60% out there that it tends to be much higher margin that you can begin to tackle with software services. Think about autonomous vehicle subscription models in the future. And so we do see as part of our industry thesis that the future of this business model isn't just about selling a car and making kind of money on the one-time sale, but really thinking about the entire lifetime revenue that a vehicle can generate, plus incremental revenue from services, peer-to-peer sharing, deliveries, that really autonomous technology can unlock over time. But it is a difficult challenge. You've seen a lot of companies, kind of take longer to develop level 3 and level 4 technology. You could argue that, Apple kind of shutting down the program suggests that maybe a more negative view on the long-term potential, but then you could also argue that the companies who are kind of leading the way for level 4 will ultimately build much bigger competitive moats just because of how difficult it is to ultimately achieve that degree of technology and capability.
What was so interesting was obviously the price point at which Apple was originally going to be targeting. I mean, there was talk of a $100,000 car. That immediately made me think of the BYD news earlier this week that they're going to be having some supercar coming onto the market more than $100,000 in terms of a price point. Is that where the competition now lies for a Tesla, for a Ford, for a GM? It's not actually homegrown Apple. It's looking over at what China's doing in a BYD.
Broadly, yeah, there's a lot of competition, of course, broadly coming out of China. I think every automaker is keenly focused on it. There's different degrees of EV penetration around the world, the U.S., of course, being smaller. But we actually do need, we think, in the U.S., more EV product, particularly in more affordable price segments that have not yet been penetrated. It is going to be a competitive market going forward. But yeah, I do think that even with the slowdown today in EV adoption, of course, the competitive threats globally are still quite there. I think automakers are certainly thinking about that, not only, again, when thinking about the EV platforms, but also incremental services, revenue from autonomous and software, of course, being a big part of ultimately making the economics work, particularly at those lower price points.
And this is where, I suppose, the starkness of the data is so raw. The fact that we're expecting an 11% increase in sales of EVs in the US this year compared to a more than 40% increase in the year of 2023. I mean, ultimately, is this the only way that these companies can distinguish themselves, can survive, perhaps tap some of the talent that's about to be let go at Apple, is by driving the services? Because Apple's got CarPlay, but obviously there's much more margin generation to be done in some of the other auto sectors.
Yeah, it's really all of the above. I think every auto company is trying to work the numbers to that creates some delays, frankly, in new product introductions to make the P&L and unit economics work for EVs. But there's no question over time that software and services is key towards making those economics even stronger, and again, unlocking longer term a lot of revenue opportunities I spoke about a bit before. But in the U.S., we're not as negative on EV adoption as consensus is today. We actually think the U.S. does need more product to drive better coverage. We've seen a very uneven market in terms of the number of products today, and of course auto companies with EVs. We've seen a very uneven market even when you look at the geographical distribution of electric vehicle sales in the U.S. And so we think it'll be slow and steady growth. There's not been a disruptive, of course, transition, which again is good for the so-called legacy automakers. It sort of supports this notion we've been writing about the sort of comeback of the legacy automakers in some degree. But ultimately, EVs we still think are the future, and when done well and right, they're very compelling products, and we think that automakers are still going to be investing pretty aggressively into them.
And when the infrastructure is there to support it too. Citi Global Head of Auto Sector, Itai Mikhaeli, it's so great to have you on the show. We appreciate it. Meanwhile, there's more news coming out of Apple in particular, with the latest on allegations that the company has imposed software and hardware limitations on its iPhones and iPads that actually impede rivals from effectively competing. Now, representatives from the company met with the Justice Department last week in what is a final effort to persuade the agency not to file an antitrust suit against Apple. It's all according to sources. The suit is expected to be coming in the next few weeks, likely by the end of March, so the sources say. We got to check in on Bitcoin today because we are trading ever so close to the record high that we saw all the way back in November 2021. We're back at a 61,000 handle. Remember, 69,000 is the record high that we saw for Bitcoin. We're up another 7.7% on the day. This is notable given risk assets are actually selling off more broadly today, and tech hasn't got much love, and we're more focused on a Federal Reserve. But Bitcoin manages to push higher despite that. Let's dig into risk assets across the board. Ipek Oskar-Deshkaya is with us, senior market analyst over at Swissquote. We're going to be getting your tech markets feel out here. And more broadly, I mean, when you're looking at a risk asset of Bitcoin, is the story more about mass adoption, about that being a meaningful part of a general portfolio as to why we're seeing a run up at the moment?
Well, exactly. I mean, Bitcoin has become like an important thing for the financial industry, and we think that it's got a great future in terms of finance and decentralized finance and, well, the next couple of years. And the fact that we also saw the ETF seeing the daylight is very important in terms of adoption. And what's interesting is if Bitcoin could actually break that correlation that it has with the traditional risk assets, then it would be just a very interesting asset that someone should hold in his or her portfolio, because it's just a different thing that is moving on different fundamentals, and it's really a great alternative for portfolio diversification.
Let's go to earnings season. It's a game of artificial intelligence or artificial sweetener, because everyone's doing buybacks. And if you look at names like eBay, I think back to Disney, Mercedes-Benz in Europe, everyone's doing buybacks, and it kind of makes earnings season seem like really euphoric. Well, how do you feel about that?
Well, the earnings season for big technology companies has been good beyond the buybacks, because if we are looking at Magnificent Seven stocks, well, they eke out some 55% earnings growth, and that's a big deal. And it's even a bigger deal when you think that expectations have gone just through the roof. So we think that there is something fundamentally positive there in terms of, well, development, and AI was obviously the major takeaway of this earnings season, because what we see is, well, AI investments are really pouring in. And when we talk with industry heads, well, we also realize that the investment decisions in AI seems to be, well, quicker than other investment decisions, because in industries and companies seem to understand very well how AI is going to increase their productivity, decrease their costs, and improve their profit and their profit margins. And they also have quite a short payoff period. So investments are actually pouring in, and that's absolutely helping the big technology stocks, especially those who are related to AI, will just eke out some mind-blowing results.
The main beneficiary of this story continues to be NVIDIA, right? The hardware provider of the underlying technology. The thesis you just outlined is more about the end use or the end case. Do you still think it's important to stay closely aligned with names like NVIDIA, AMD, and some of the hyperscalers?
Well, I think that yes, because those are the early comers and they are the pillars of this AI revolution. What we see in AI today is a little bit like the digital version, the digital equivalent of the Industrial Revolution. So the potential is absolutely huge. Now, looking at the valuations, yes, NVIDIA's valuation has gone through the roof, but the valuations as of today are not that shocking, because NVIDIA's valuation in terms of PE ratio is lower today than it was at last year's 2023 peak. So yes, the NVIDIA stock price is going higher exponentially, but the earnings follow as well. So we think that NVIDIA is a very interesting stock to hold in an AI portfolio. And zooming out of NVIDIA, the global technology stocks are also trading at valuations which are lower than their 2021 peak levels. So by historical terms, the valuations that we have today are not that shocking.
Yeah, if you're looking at forward PE, well, the ratio there is like a 30 or thereabouts for an NVIDIA. It's only 16 for a Qualcomm. And I bring up Qualcomm because actually the CEO of that company was joining Bloomberg a little bit earlier. And, well, guess what he was excited about? Just take a listen.
While we cannot predict when is the next cycle, what I can tell you right now with precision is AI is changing how we interact and how we use our phones. And if consumers feel that they need to have an AI phone, that will create this new growth momentum for the industry.
Ipek, we've of course heard Cristiano Amon talk a lot about AI applications and of course the AI use within our smart devices. But should we broaden our remit of investment opportunities at this point? Should we look less at perhaps the picks and shovels? Where are the applications? Are you looking at other industry groups now?
Well, absolutely. I mean, we can broaden this to chip makers, and especially you can also broaden your vision to geographically other diversification opportunities. And for example, Japanese chip makers or Japanese companies in the chip sector are also looking very interesting to us in terms of good diversification opportunities while having an exposure to AI. Now, obviously, other technology areas are very interesting as well, because technology, as by nature, is very adaptable to, well, AI revolution. So every company that has potential to improve their products and services with AI are interesting to, have in a AI portfolio.
Any guest that comes on the show and says something like technology by its very nature can come on the show again anytime. Ipek Oskar-Deshkaya, Senior Market Analyst at Swissquote. Just a terrific conversation. Thank you. Back to Bitcoin really quickly. Hit $60,000 for the first time in more than 2 years. This comes as demand for the token is widening beyond committed digital assets enthusiasts. That's been the story. Meanwhile, US Senator Elizabeth Warren sat down with Bloomberg yesterday, a wide-ranging interview on the looming government shutdown, the path ahead for rates, but also crypto regulation. Have a listen.
In our financial system, pretty much everybody follows the same set of rules. I'm talking banks and credit unions and credit card companies, gold traders and stockbrokers. Private equity now has to follow the rules. Precious metal dealers, Venmo, Western Union, but not crypto. My view of the world is same kind of activity, same kind of risk, should have the same regulation.
Google, we have a response from the CEO, Sundar Pichai, sending an email to his staff. What has been, of course, the problematic responses from Google's Gemini AI engine, describing them as, quote, completely unacceptable. It's according to a note that teams are now working around the clock to rectify the issues. For more, let's bring in Bloomberg's Seth Feigerman. And Seth, I mean, to put it lightly, problematic. But is this enough? Is this sort of like mea culpa moment? This is not good enough for ultimately the damage to the brand that this has done?
Yeah, I mean, on some level, the question is this even a fixable problem? And it's very unclear right now that it is. They're saying they're going to work around the clock, test out different prompts and try to weed out bad cases like what we saw over the last week. But the technology itself is fundamentally flawed. The data it's trained on is fundamentally biased, and they are attempting Band-Aid measures here just to get the product out there. So even if they wait 2 weeks, 3 weeks, a month, we may still see users effectively troubleshoot it in the wild and find other issues.
When we've actually gone to spokespeople at Google, they say Gemini is built on creativity and productivity tool. It may not always be accurate or reliable. But as you say, this is an overcorrection of previous lackings in other AI generators. And I'm interested as to what really has gone wrong from a technical perspective.
Yes, what we understand is that behind the scenes, Google has effectively tried a technical fix here. They have done what we call prompt engineering. They are, when you enter a prompt and say, give me a picture of a nurse, ordinarily on certain image generators will show you a woman by default, or often a woman. But maybe now, without you even knowing it, it'll add, show me a male nurse and a woman nurse and a nurse of this ethnicity and that. The problem is users don't know that's happening behind the scenes, and in overcorrecting for it, it seems like they almost prevented you from being able to see an image of a white person in that role or any other. And so it just speaks to the urgency right now these companies feel to deploy these products, even if they can't properly safeguard for all bad use cases.
Meta has a white paper just on trying to explain this phenomenon. Seth Feigerman, great to have you on. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. A quick check-in on the markets. I guess we're kind of like treading water right now. We get core PCE Thursday. There is still a micro focus on what economic data will lead the market to believe the Fed is going to do. And you see US 10-year yield around 4.29% where it's been. Equity markets a little softer, 0.3% on the NASDAQ 100. It's a very tech-heavy index, which is why I always check that. We showed you once, we showed you twice. I should show you a third time. Bitcoin above $61,000 per token. Go back 2 years when it was at that level. What happened in the same month as it reached $69,000 per token? Where will we go next? It's exciting. We'll keep on track of it. I do want to go back to Alphabet, parent of Google. I know we just had Seth, our AI editor, explaining Sundar Pichai's reaction to what are inaccuracies and bias problems in Gemini. And you can go on Bloomberg.com, see that full memo that Bloomberg's published, he sent staff. But we're down another 2% in the session and trading at one point in the session at the lowest level for Alphabet since mid-December. So there's a clear reaction here. We're going to keep on top of the story because there is a debate, Carol. You and I have been talking about it all morning. How do they actually fix this? Technically, or is it not as straightforward as that? It's one to watch, certainly, and we're down 5% in the last, or 4.5% in the last 5 sessions or so.
I mean, all of this brought on by prompt transformation, something that we'll get far more used to. Meanwhile, yesterday, Ed, Sony, of course, announced that it would be laying off some 900 employees in its gaming division and will completely shutter PlayStation London. That brings the amount of video game industry workers who have lost their jobs this year to more than 6,000. Let's bring in an expert in the field. Jason Chapman joins us, co-founder and managing partner over at Convoy Ventures. It's a firm that actually invests in platforms and technologies in gaming. And from the perspective of the industry here, Jason, is this something we're going to see across the board? Because for Microsoft, when they made layoffs, we sort of thought, oh, it's the M&A deal. But more broadly, is this another industry group that got too big during COVID and now has to slim back down?
Thank you for having me. While these layoffs were significant. They're not surprising. We're going to continue to see more layoffs throughout 2024. For context, we saw about 3% of the global gaming workforce laid off in 2023. We're in February, and we've already seen 2% of that workforce laid off. We expect that number to continue to rise, both with groups that have already done rounds of layoffs like Microsoft Gaming, Unity, Riot, and others, and also some newer companies that haven't yet announced.
Why, Jason? Why are the companies doing this belt tightening?
It's a great question. It's because money is not cheap anymore. We were all bloated and we got way too comfortable, hired way too many people in the post-COVID boom. Every company, including in games as well as in tech, is having to right-size their industry. We need to do more with less. We need to get more capital efficient. And I think you're seeing that hit gaming in full force in 2023 and 2024.
Okay, so the narrative back in early 2023 when the big tech companies were belt tightening was, well, they'll leave some of this talent and go and build their own ventures. But is this also happening at the startup level? Are you seeing belt tightening, layoffs happening there too? And ultimately, what does it mean for your part of the industry?
Absolutely. It's happening both with the big players and also the small players. So, the startups are not isolated from these concerns either. We've seen across many of our companies an average of about 30% pullbacks in staff, and we expect that to continue. And all those companies are either doing the same on a top line basis or actually better. And so I think that just shows you that we got inefficient. And I think that's a lesson learned in games. It's a lesson learned in tech. And as I said before, money is not cheap anymore, and it's very hard for them to raise both in public and also in private settings for capital.
I think long term, we're talking about generative AI being a tool to accelerate game development. But right now, I'm playing PlayStation right now, I'm playing Switch, I'm enjoying the games, but there isn't sort of one title or trend or thing that I'm really excited about in 2024. Maybe Star Wars Outlaws, shout out that game, it's going to be incredible. But do you see what I mean? There isn't a sort of short-term catalyst to drive a spending cycle. I wondered if you agree with that, Jason.
I think you're going to have to look to the UGC platforms. You're going to have to look to Roblox. You're going to have to look to UEFN with Epic and Fortnite. Obviously, huge announcements there with the Disney investment. I think you're going to see a lot of new titles come from those regions versus kind of these standalone huge titles that you see more historically announced by the major groups. So I would tell you, go on Roblox. Let's go play on Fortnite together. There's some exciting things coming down the pipeline there. But definitely noted also the big disappointment in the games industry obviously is that Grand Theft Auto got delayed to 2025. That was a huge disappointment for many, and probably it sounds like for you, Ed, as well. So yes, while in the games industry, we're going to have to make do with UGC for a little bit. There are some other exciting titles coming out here, and I think we're going to have to make do with some of the older content for the rest of the year.
Okay, 1, let's play Fortnite. 2, Roblox. Okay, 3, yes, very sad about GTA.
Yes,
Compro Ventures
very
co-founder.
sad.
Managing partner Jason Chapman, you bring it all. Thank you so much. Okay, I've been waiting to show you this for a long time. In 2023, San Francisco positioned itself as the place to be when it came to AI, and investors backed that title. But what happens next? I looked at what's really going on in our city for Bloomberg Originals. Welcome to the real Cerebral Valley.
This is the Hayes Valley neighborhood of San Francisco. It's characterized by the painted ladies, hip shops and restaurants, and its fairly diminutive size. Blink, and you miss it really. But tech industry locals see Hayes Valley, or Cerebral Valley, as they like to call it, as a metaphor for what's happening in San Francisco. It became the epicenter for new and growing AI companies, part of a vanguard that could help SF bring back business that slipped out to Silicon Valley or even out of state. I talked to a couple of local tech luminaries to see how much of this is real and how much of this is hype.
Every revolution in Silicon Valley sort of happens in waves like that. There's personal computers, the internet, mobile phones, and I think that this is as big or bigger because what you see is now software being able to reason, and that's transforming not just one or two industries, but absolutely all of them at the same time.
So what happens in the next 12 months with artificial intelligence in this city?
One of the big things that we talk about in San Francisco is the doom loop. The commercial buildings are completely empty. Prices for real estate have completely crashed, but the silver lining here is we're going to fill every one of those skyscrapers with thousands of very high-paying jobs that then create software and products that basically serve billions of people out there.
And some folks on there that don't agree with that view as well. Check out the full documentary on Bloomberg Originals, Bloomberg.com, and all the social platforms. Caroline.
Meanwhile, Ed, look, VC-backed Klarna shrank its net losses by 76% in 2023. We're talking about a fintech, buy now, pay later firm over there in Europe, not in Cerebral Valley, that makes preparations for one of its biggest IPOs of the year. Now, the fintech company is even briefly moving into profit. That happened in the previous 3 months. It's all accelerating its pace of growth as we've seen targeted further expansion right here in the United States, which is now its biggest market. Now, interestingly, part of its growth has actually been thanks to OpenAI-powered AI assistant, which Klarna says is doing the equivalent, get this, of 700 full-time agents and has 2.3 million conversations with the first month of being deployed. Now, that announcement was enough to send the shares, as you'll see, of Teleperformance down 29%, hitting their lowest level since late 2016. They say, of course, they're an outsourcing company that is all about, well, on the phone and people. Let's see what's coming up when it comes to AI disruption. A new AI image generator is in town, and we just got the backing of Andreessen Horowitz. More on that one next. Meanwhile, let's just keep an eye on some of the publicly traded companies that we've got to be looking at. Applied Materials, this one down, as you'll see, just some 2.3%. This is more of a legal ramification for this company. The US is renewing an inquiry into Applied Materials' Chinese business. They're underscoring Washington's efforts really to curb chips being sent to that particular company. We're off by 2.4%. This is Bloomberg Technology.
New funding for AI companies keeps pouring in, and this time it's Ideogram announcing $80 million in a Series A funding round led by Andreessen Horowitz and launching a new version of their image generation model. Joining us with the deets, Bloomberg's Rachel Metz. The timing of this is astonishing, but let's focus first on Ideogram. What is it that they do? Who are they? What can you tell us about them?
Sure. So Ideogram was formed by some people who worked on Google's image generation technology initially, and they launched their first version of their software last year. And basically, they are concentrating on making it easy for people to come up with really good AI-generated images without having to put in like a really lengthy written prompt, and also typography. They're really focused on making it so you can have legible words in your images.
Ironically, it was led by several former Google employees. That timing, therefore, juxtaposed with the issues going on with Google, but also the exuberance around video generation and a more image-based focus of Sora, for example. This is why we're garnering this sort of valuation, Rachel?
Yeah, I mean, well, I think that the funding that they're getting this time around it's a lot of money for a company that's not very old, but I think it's really reflective in part of how much computing power you need, which is very expensive in order to train these models and to run these models. They need to hire some more employees. I think they're still a pretty lean startup over there. But as you said, the timing, yes, very interesting. In fact, one of the things that's very interesting, in addition to this funding that they're getting, they have this new model. One of the new features they have allows them people to turn on or off automatically lengthening their prompts, which is something that some companies do, but they don't always talk about to users. So this way it'll be very obvious to users whether that's happening or not.
Prompt transformation, something we're talking about several times today that hasn't really been discussed before. And also, talking of timing, Stability AI's latest image generator as well. Got a lot of people talking. Rachel Metz, absolutely brilliant to have you on, as always. Thank you. Now, let's stick on the world of venture capital and our VC spotlight today. We want to take a look at Black Tech Nation Ventures. It's a Pittsburgh-based venture firm which has just announced the close of a $50 million inaugural fund to back software startups led by founders from diverse backgrounds. Let's bring in general partner David Motley for more, who's staying up late for us while traveling in Hong Kong. But where will your money be deployed, David? Is it more US focused? Is it Pittsburgh focused? Are you agnostic?
Caroline, thank you. Let me start by saying we really appreciate the opportunity to be on your program. Excited about the attention that our fund is getting. Fund 1 launched on its way, and we're looking forward to earning the right to launch a much larger fund too to follow. With respect to where we are investing nationally in technology funds that are led by Black and diverse founders, with an eye towards delivering outsized returns to our founders.
Thinking of your founders, you've already invested in a whole gamut of like the future of finance with M-Tech. You're looking at Good Find, which is helping sort of, well, food trucks and the like. But I'm interested, David, you say about the attention your fund has garnered. I'm going to be brutally honest, $50 million isn't that much in the grand scheme of things of VC, but what's sad is it's large when it comes to backing Black founders and raised by Black VCs. Why is it still only a 50 million, if you can dare say only? And what are some of the headwinds that you've found trying to raise this fund?
Caroline, your point is well made. $50 million in the scheme of venture is a very small fund. We do have the opportunity to leverage what we're doing with our fund with other like-minded funds and deliver much larger scale relevance for the companies in which we invest. One of the reasons why venture is retreated for Black-led funds is that the overall venture market declined in 22, 23 after watershed years, if you will, in 20 and 21. But in particular, now that the attention that was garnered on the backside of the tragedy with George Floyd is retreating in the rearview mirror, funds are also moving away from this sector.
David, I'm looking at this data point. Around $700 million of venture money went to Black-founded startups in the US last year, below $1 billion for the first time in a long time. What's the trajectory looking forward? Thank you for your time on the show. We're very interested to talk about the fund, but I'm assuming that you feel like you can't do this on your own. Are you getting support from other firms who are raising funds with the same intent?
So the answer to your question is yes. We are getting a lot of support and interest from other like-minded funds. We have, in fact, convened a forum for Black-led funds across the country. When we take a look at what's it going to take to try and move the needle, it's going to be funds like ours proving out that there is alpha in this sector. There is the opportunity to deliver success from funds like ours, from founders like the ones we're investing in, and prove out that this is not just an initiative, but an investment category that can provide venture-like returns.
Well, for now... Sorry, Ed.
Oh, no, Kara, go for it.
Well, I mean, it's notable that for now you got backing from Alphabet, First National Bank, Mark Cuban, to name but a few, Ed.
All right, Black Tech Nation Ventures General Partner David Motley. We got to go, but by the way, super grateful for you joining us in Hong Kong. Very late there. We'll have you back in the future. Appreciate it. Data automation and marketing firm Klaviyo out with fourth quarter earnings after the bell last night. It's only the second report they've done as a public company. Revenue beat estimates in the final few months of the year. Joining us now, Klaviyo CEO Andrew Bialecki. Andrew, they talk about that period of the year being seasonally strong. But if I'm trying to pick out a story, it's that you added a lot of new customers. And I wonder if that was a direct result of the IPO. One rationale for going public is let's get our name out there.
Yeah, well, first, thanks for having me. We're really excited about our results in the fourth quarter. As you mentioned, we work with a lot of retail and e-commerce businesses and brands, over 140,000 of them. And Q4 is their time to shine. And we're really excited that last year, we helped those businesses generate over $50 billion in sales. At Klaviyo, we're all about helping businesses and brands build first-party relationships with their customers, with end consumers, and then building great experiences for them that helps them drive real growth.
Let's just talk a little bit about, though, where the headwinds are, or indeed why the share price is down. I know risk assets are down across the board at the moment, Andrew, and I'm sure you don't look at the day-to-day vagaries of your share price, but it is lower, perhaps more on an earnings per share perspective, and maybe Morgan Stanley coming out with a price target downgrade. I'm interested as to what, if anything, you're having to spend a lot of money on, even as you're driving up revenue and growth in terms of users.
Sure. Yeah, we don't spend too much time thinking about the stock price day over day. I'll tell you what I'm excited about. Yesterday, we launched Klaviyo AI, which is our artificial intelligence toolkit for all of our businesses and brands. As we look forward, we've built Klaviyo as a great platform for any consumer business to build direct relationships with their end customers. We think the future of marketing and really CRM is all about autonomous. Autonomous doesn't mean that marketers are out of jobs. It means that they're back to doing strategy and creative work, working on the brands, and out of the minutia. So, we launched a series of features that I think are going to become table stakes. Things like the ability to create email content from a prompt or automatically optimize that email or SMS or your website without a marketer having to do all the editing and testing. The AI can do it for you. And we're really excited about the results that that's driving for customers. Just as an example, Willow Tree started using some of our predictive analytics, some of our machine learning-based, artificial intelligence-based tooling, and that increased their revenue from email by over 50%. What's great is I think artificial intelligence is going to allow a lot of marketers to not only free up time, be more productive, but it's going to drive better results. And, we're spending a lot of time and, frankly, human capital investing in building out that functionality.
Okay, so you hiring on that front, therefore, Andrew? Are you going to do more with less when it comes to your own people power?
Yeah, well, we've already been, we founded Klaviyo, we bootstrapped our business, so we've always been a very efficient company. But yeah, we're hiring a lot of folks on the artificial intelligence and product and engineering side. We're also seeing great demand from larger brands, brands like Mattel, Good American, Marine Layer, that are choosing Klaviyo. So we're also investing in increasing our sales capacity as we see a lot of demand from mid-market and enterprise brands that want to move on to our tech.
Andrew, we just have 15 seconds. How much do you think you spent R&D-wise in launching Klaviyo AI?
Yeah, we've been efficient at it. Our costs to build that have not been as large as some of the foundational large language models you see out there. And the other really great part for us is because we're so close to driving value, we can show our customers the actual revenue that artificial intelligence is creating for them. I think there's going to be opportunities for us that as our customers, see more of that value, that we can also partake in that, that value creation, that monetization.
Well, enjoy that sunny day behind you. We appreciate you coming on, talking us through the numbers and the AI focus. Klaviyo CEO, Andrew Bialecki, of course, on the second set of earnings as a public company. And meanwhile, that does it for this edition of Bloomberg Technology.
A huge show, a huge week. Check out the podcast. You know where to find it. Bloomberg, Apple, Spotify, and also on iHeart. It feels like earnings season's kind of in the rearview mirror, but AI just doesn't go away. From New York City and San Francisco, this is Bloomberg Technology.